right, Chapter 8. Chapter 8, we talk about account receivables, and we get a little bit more into it. So account receivables aren't new. They're the right to receive cash in the future from customers. And we've been doing them for the last several chapters. All right, so it's the right to receive cash for goods or services that have already been performed. All right, they're normally due within a relatively short period of time. All right, so like 30 to 60 days. If it's for goods and services, there might sometimes be called trade receivables. You might have other types of receivables, such as interest receivable, dividends receivable. You know, the list could go on. All right, these receivables that are usually due within usually paid to you, or you have the right to receive them within 30 to 60 days, they're typically classified as current assets. All right, and they're also a little less formal than a note receivable, which we'll do a little bit on later in the chapter. They're less formal than a notes receivable because they generally don't have interest attached to them, and they're not necessarily a written agreement. It's more like a friendly type of agreement. You might fill out one piece of paper at the beginning of the relationship, but then you don't have to fill it out every single time you buy something on account. Okay. Oh, we just did that. Okay. So let me talk about that. Note receivable, which I think we do a little bit later in the chapter. They usually, well, I guess I'll use their terms. They have longer terms. So it might be like 6 months, 18 months, 5 years, whatever the case may be. So they're going to be a current asset or a long-term asset, depending on how far out it is. Typically, interest is paid with a note receivable. So it's collected. Interest is collected when the note receivable is collected. All right, here are some other types of receivables. Most of them are going to be current of this nature, like interest receivable, dividends receivable, but it all depends on when they're collected. Okay, so the actual journal entries for account receivable, the basic journal entries, we've done many times. Okay, they're not new. So in this case, Smart Touch Learning performed $5,000 in services on account and sells 10,000 of merchandise inventory to a customer on account. So 5,000 services to Brown, 10,000 of merchandise to Smith. Oops. So on August the 8th, we had account receivable to Brown and service revenue because we performed a service for the 5,000. And also on the 8th, we have the account receivable to Smith because we sold him something. And then they didn't tell us what the cost was, the cost of goods sold. They told us to ignore it. But remember, whenever you sell something, you typically have two entries. One one for the recognize the receivable and the revenue that we just did, and one for cost of goods sold and out of merchandise inventory. All right, and we don't know the dollar amount for that, so I'm just going to leave it. All right, now they do talk a little bit about subsidiary accounts and control accounts. If you're a really large corporation, you may have hundreds of account receivables. All right, in the general ledger, you cannot have each individual account because that would just take up too much space. So in the general ledger, you would have the control account, the balance of which would be the total of all account receivables owed to you. Right, and then in the subsidiary ledger, you would only have account receivables, be the accounts receivable subsidiary ledger. And you would have individual accounts for each person that owes you money. And then the total of the account receivable subsidiary ledger equals account receivable in the general ledger. Okay, then when you collect the money on this, so they collected the money on August the 29th. They collected the money from both of them. So they received cash of $15,000, and it came out of Brown's and out of Smith's. Next up are credit card and debit card sales. I have a hard time saying these things. Generally, credit and debit card sales are recorded as cash sales. However, banks will charge a fee for their use, because basically the bank is assuming the risk, especially with the credit card, the risk that they're going to get paid. Oops. All right, so it's typically recorded like a cash sale. But it can be recorded net of the fee, or the fee can be recorded later, which is called the gross method. Okay, so for instance, they sold $3,000 on credit to a customer. The customer used a third-party credit card, so like a MasterCard or a Visa credit card, and the credit card company charges a 4% fee. All right, so if it's the net method, then on the day of the sale, you're going to record the cash net of what you expect to get. So it was $3,000. They charge a 4% fee, so you're only going to get 96% of it. All right, so that was 3,000 times 96%. All right, or you can also do 3,000 minus 3,000 times 4%. But I like just doing the other method, it's faster. All right, the credit card expense is the 4%. And then sales is the total of 3,000. All right, and then when you that's fine. Then the other method, the gross method, you record it at the 3,000. And then when the fee is charged, or at the end of the month, when you find out what the whole fee is going to be, then you record the credit card expense and reduce the amount of cash. Sometimes they'll take it out of your bank. Sometimes they take it out of the deposit before they make it in your bank account. The credit card company does. Or sometimes they take it out once a month after they've batched everything.